Namaskar, hello and a very warm welcome viewers. You're watching Bills and Insight, your one-stop destination for views, news and analysis of proposed legislations of India that have far-reaching implications and impact your life. I'm your host Kriti Mishra, and today the spotlight is on the National Bank for Financing Infrastructure and Development Act of 2021. The Act establishes the National Bank for Financing Infrastructure and Development as the principal development financial institution for infrastructure financing. On February 1st, while delivering her budget speech, Finance Minister Nirmala Sitharaman announced the decision to introduce a bill to set up a professionally managed DFI to act as a provider, enabler and catalyst for infrastructure financing. Let's take a look at the highlights of the Act. National Bank for Financing Infrastructure and Development will be set up as a corporate body with authorized share capital of 1 lakh crore. It will directly or indirectly lend, invest or attract investments for infrastructure projects located entirely or partly in India. The bank will also facilitate the development of the market for bonds, loans and derivatives for infrastructure financing. But what is a development financial institution? Well, DFIs are set up for providing long-term finance for such segments of the economy where the risks involved are beyond the acceptable limits of commercial banks and other ordinary financial institutions. Unlike banks, DFIs do not accept deposits from people. They source funds from the market, government, as well as multilateral institutions and are often supported through government guarantees. Irrespective of the level of development, countries across the world have set up development banks to finance key infrastructure and manufacturing projects. For instance, the European Investment Bank acts like a DFI for Europe. DFIs in India like IDBI, ICICI did play a significant role in aiding industrial development in the past. After 1991 reforms, these DFIs had to change their track due to changed policy stance and business environment and had to convert themselves into universal banks. And for deeper understanding of the Act, I'm joined by an illustrious panel of guests. Joining us in the studio, Mr. Syed Zafar Islam, Rajya Sabha member of the BJP. He's also a former investment banker and the former managing director at Deutsche Bank. He was one of the key speakers while this bill was discussed in the upper house. We also have with us Mr. Shailesh Pathak, co-chair, Transport Infrastructure, FICCI. He's joining us through virtual platform from the national capital. And also in the studio, we have with us a very vibrant audience of young students and aspiring entrepreneurs. And before we commence our discussion, let's take a look at how our parliamentarians debated this bill.
The financial market will be extremely happy, and especially when they see the bill which embodies all the relevant aspects of a financial development financial institution which should be having to ensure that it plays a very important and pivotal role in developing and financing the infrastructure space.
When the history of industrialization in India is written, the role of IFCI, the role of ICICI, and the role of IDBI is going to be crucial. They have been responsible for the development of Indian business, for the development of Indian corporates, and I think as we launch a new chapter in the DFI, we should recognize the historic role played by IFCI, ICICI and IDBI.
बिहार के विकास की भूख को इस पाइपलाइन में कुछ प्रोजेक्ट्स लीजिए इंफ्रास्ट्रक्चर में और उस भूख को खत्म करिए.
The bond market in India is certainly not in a position to finance heavy infrastructure projects, be it road, be it railway, be it port, be it energy or urban infrastructure.
It is clearly the need of the hour and need of the next 25 years in India's developmental story that we need an institution with that kind of an architecture which has both the strength of the government backing it, at the same time being able to face the competition in the market. This act itself, as you would have, all honorable members would have recognized.
All right, Mr. Islam, let me begin the program with you. Before we talk about the specifics of the Act, after 1991, most of these DFIs were converted into commercial banks and infrastructure financing became a part of mainstream banking or financing. Why do we need DFI now Why has it regained its prominence?
Well, you have to understand whether it's IDBI or for that matter, when initially IFCI was set up, there was a purpose, and we understand that what was the purpose, why they were those institutions were set up, but they have served their utility, and that's why we needed a dedicated financial institutions which actually works away from the commercial bank and the activities of the commercial bank. What the development financial institutions requires these days, because we have huge infrastructure pipeline of over 111 lakh crore. And these commercial banks cannot and not in a position to fund those projects. You need a dedicated financial institutions who have the long-term liability with them and have the long-term resources. They have the long-term access to long-term capital. In turn, they can on-lend to such infrastructure projects. So what we were facing recently, that earlier development financial institutions were struggling, like IDB and all, because they do not have access to long-term capital, be it bond or equity market. They were struggling to raise those kind of resources. But today we have a very diversified capital market. We have a investor, be it insurance companies or the retirement benefit funds. Those funds need long-term liabilities, long-term assets.
Yeah.
And these institutions require long-term liabilities. The problem with commercial banks, they have short-term FDs, and they work on the model of CASA, current account and saving accounts. So the weighted average maturity of those deposits, as well as the whatever money they have in the CASA, current account and saving accounts, put together, the average maturity does not exceed 1 year. Well, if you just see the requirement of all the for the projects which needs to be funded and financed, infrastructure projects, that requires long-term financing.
Yes.
So there is a huge asset liability mismatch between the liability what they have and the assets what they intend to acquire. So if they want to lend to say a project, a road project, or for any infrastructure project which has the door-to-door maturity of 25 years, and even if you do, you lend those projects and you have an amortization schedule, but still the average maturity of that loan is beyond 10 years. Obviously, these banks are not in a position, because their liability is only for 1 year, while they are acquiring assets of 10 years. If there is any the interest rate volatility, it is bank which is going to be affected. And also, if there is any liquidity pressure, it is bank which is going to be affected. If there are NPAs, then again banks are going to be affected. So what the government of India decided to have is, and it was a long outstanding demand, to set up a development financial institution which have a dual role of development of financial market as well as funding and financing of those long-term, long-dated infrastructure projects. That's why this has become a reality, and I'm sure the kind of support which the government of India is extending to this development financial institution and kind of infrastructure pipeline we have, this institution will be a catalyst for a major economic growth and economic activities in the country, because we have a huge pension funds, provident funds, and many other funds available who needs long-term capital, long-term assets, and they are happy to invest in bond issued by the development financial institution. The government of India decided to set up this institution, and I am sure this will serve the purpose, and it will definitely also bring, as you initially shown, that this will also help government of India in setting up a very strong, liquid, deep capital market, bond market, where you have the derivatives also, liquidity derivative market, as well as a normal bond market across the rating curve.
So you're making a very important point there, that the risk-taking capacity or ability is going to be very, very different here. Let me take that to Mr. Pathak. Mr. Pathak, since we're talking about national infrastructure pipeline, we're talking about Gati Shakti, despite the debilitating impact of COVID-19 pandemic, our target is to become a $5 trillion economy. Certainly, this bank or this DFI becomes need of the hour.
And let me begin by saying that I listened to the finance minister's speech earlier in 2021, setting the three themes. One is increased budgetary allocations for infrastructure. The second was setting up institutional structures, which is the DFI, the NABFID. And third is the monetization pipeline. So now that we have the National Infrastructure Pipeline, which is about 7,400 infrastructure projects costing about 111 lakh crore, 111 trillion rupees. Within the financing of the NIP, it is clearly spelled out that around 85% of the financing will be from budgetary resources. So whether it is the government of India, the government of the states, or the government of the cities, at all three levels, the financing, 85% will be from budgetary outlays. The balance, 11-15%, is to be met through A, the DFI, and B, asset monetization. And now we have a national monetization pipeline, which we will talk about later. But within that 15%, I expect around 6 to 8% to be met by the DFI, which is called the National Bank for Financing, Infrastructure and Development. And then I very keenly listened to Syed Zafar Bhai talking about the NABFID bill when he was introducing it in the Rajya Sabha. And therefore, the question is, why DFI? The DFI that we had earlier, in fact, I started my career in 1986 with ICICI, which was a DFI at that time. Those were DFIs, development financial institutions focused on industrial development. So whether it was IFCI in 1948, ICICI in 1955, or IDBI carved out of the Reserve Bank of India in 1964, they were all industrial focused, not infrastructure focused.
Yes.
So we used to give loans above 3 crores for large industries. At that time, 3 crores was a lot of money. And my first day on work, I handled a 100 crore fundraise. And that got over in the next 25 minutes because our bonds were in the nature of promissory notes, eligible for statutory liquidity ratio of the banks. And I still remember the first check I got was 10 crores from Central Bank of India. So raising money at cheaper rates is the crux of DFIs.
Absolutely.
If you don't raise cheaper money, how can you give cheaper money? And the good thing about the NABFID bill or the act right now is that cheaper money will be available to this entity. The status report as of today is that Mr. K.V. Kamath has been appointed chairperson of the DFI, NABFID, and he has some solid credentials because he has just set up the BRICS Bank, the new development bank, 5 years ago in Shanghai. And I was actually asking him what we should do in the NABFID, and he gave 4 or 5 steps that we could follow. Of course, this was before he became chairperson. But why the DFI now for infrastructure? As Zafar Bhai said, infrastructure funding is very different from industrial funding.
Yes.
And, commissioning of projects takes longer and incoming cash flows take even longer. Just to give you an example of a project that our company has done. We built one of the longest highways in India on a PPP basis. And we took 910 days to build it within time, within cost. And now we have a 25-year concession to get it back. So funding of this was earlier done by public sector banks or private sector banks. And as Zafar Bhai said, they had an asset liability mismatch. Something like the NABFID will be able to extend credit to such projects, not only in the private sector, but also in the government sector. It's not only PPP projects that NABFID is supposed to look at.
Right.
And will also be able to add both to the development aspect of infrastructure, including project preparation, and to the deepening of the financial markets, which is bonds, loans, derivatives. So all told, this is why the DFI. Now, how the DFI?
Yes.
So we have actually, I've gone through the entire act, and it is a very well drafted act. It takes care of the issues that plagued earlier iterations of the DFIs. And Section 17 in this act is particularly worth noting because it lists out all the activities that NABFID can do.
One of the concerns, Mr. Islam, that was raised during this bill was discussed in Parliament was that there is lack of external oversight. How do you allay those concerns? What are the kind of safeguards envisaged in the Act?
See, as Mr. Pathak was talking about his first experience, I think it is important to understand that the bond was subscribed within 25 minutes. Why? Because it was a risk-free bond. The government of India was treated as a statutory liquidity rate for the purpose of its SLR. So it was a risk-free bond for anyone, and the rate of interest was very high. Even at that time, it was very high compared to any other government securities and all. today, if you just see, I'll come back to your question, but just say that what these banks like IDBI and IFCI, or for that matter ICI, they were struggling because that government guarantee was not there. So obviously, when you access the market, you are at par with others.
Yes.
So why would you get a better, at a cheaper rate bond, you will be able to raise compared to other market players. So obviously, you were struggling to raise at a cheaper cost and then on lend, because you have administrative costs as well. So that was the biggest struggle, and those concerns have been addressed, that they need to have access to cheaper capital, cheaper resources available to this development financial institution. And when you say that 5 trillion economy was something which the government of India has already stated, it's as a stated objective of the government, that we want to achieve $5 trillion economy. How $5 trillion economy, and if they don't have focus on infra space, which is actually give a multiplier effect on the contribution to national GDP. So that's why it is important that all these infrastructure project gets funded. Whatever concern, I think if you just see all the parliamentarian or the lawmakers had expressed, they had welcomed this decision of the government of India to set up, because it was a long outstanding demand that there should be a institution which actually has access to cheap capital and on lend to infrastructure project. This platform was set up by the government to provide those infrastructure project cheaper financing compared to nationalized bank, and it also taking into the cash flow modeling of that. As I said, that you complete the project, but you have a concession for 25 years. Means every month, every day, you will keep collecting cash, and then you will start repaying meeting the amortization schedule or servicing this debt which you have taken. So you need to have a door-to-door maturity of this loan of up to 25 years, or maybe if you just ignore the tail period of 2-3 years, so at least 20 years you need to have maturity of this loan. So it is important that some institution has the ability to on lend, because they have also long-term liabilities. Like for instance, if they want to take a 20 years loan from, then there is an institution called LIC or other insurance companies which can give 20-year loan, because they are looking for 20 years assets, 20-year long assets as well. So there's at least, and then the government is there to support. It's a government-owned institution. Government is there to support that. They always able to access to cheap capital and on lend at a margin after the adding the administrative cost to the potential project which is being funded by in the infrastructure space. Many speakers had spoken in the parliament, but none had spoken against this bill, because they all welcomed it, because they also know this is something which is the need of the hour, irrespective of which political party you belong. But at least you know that infrastructure is something which is so visible in the country that it requires a lot of attention and a lot of investment. And that's why everybody supported the bill, and there was no resistance from any political party not to support the bill. And there was no as such concern which was highlighted, because as Mr. Pathak rightly pointed out, that the bill has been drafted keeping two things in mind: the current requirement and all the previous experiences what we had with the financial institution which had served its utility. But there are inherent constraints they were facing, or the problems, the issues which they were facing. Those concerns have also been addressed in this bill.
Absolutely. I do remember that all sides concurred on this particular bill. But before we open the floor to our audience and to their question, Mr. Pathak, quickly, a quick comment on the international funds that we're looking at. Many international players are interested in operating our assets. How will this institution channelize funds from international markets?
So, Kriti ji, there are two ways of financing. One is debt and the other is equity. The National Bank for Financing Infrastructure Development is largely focused on debt. And for equity, the government of India has set up another 49% joint venture with global capital called NIIF, National Investment Infrastructure Fund. Having said that, I have been working with international dollar investors since 2006, 2007. And the one conclusion that we have is that international dollars are not going to come in for construction of infrastructure in India. They are going to come up once the entire infrastructure project gets constructed, it becomes an asset, and it starts giving out cash flows. Just to take another example, I was CEO of this company that was one of the key promoters of the Bangalore airport. Now, when the Bangalore airport, the new Bangalore airport was being constructed, we did not have too many international investors. It is only after 2 years of it having started commercial operations and building a cash flow that international investors came in. And today, in fact, the Bangalore airport is majority owned by Fairfax of Canada. So there is a saying in finance that always trust a cash flow statement more than you can trust a spreadsheet, because what has happened in the past is that you got these cash flows. And I also describe it as caterpillars turning into butterflies. So infrastructure construction projects become assets after their construction. So caterpillars are largely going to be done by Indian rupees, whereas butterflies, constructed assets, international dollars are going to replace Indian rupees. I say this also because one of the largest pension funds from Canada was 49% shareholder of our company. And we started an infrastructure investment trust, INVIT, in which 92% was held by marquee global investors. So we know what they are appreciative of. We know what they will not do as well. Thanks.
You wanted to make a point, sir. Yeah.
No, I completely agree with Mr. Pathak. In fact, the first INVIT which has happened was something which I worked on it after the Government of India announced the INVIT structure. First INVIT structure which has been issued by IRB was I was instrumental in giving guidance and support, handhold them while they were doing this transaction. But away from that, recently there is a change of perception about India also. They feel comfortable because of the leadership and the government, which actually gives a lot of comfort to the global investors. So what Mr. Pathak is talking, that they are not looking for greenfield project, but mostly brownfield or where the assets have been created, so they will buy the assets. But there is a change of perception, I must add. And we have concluded transaction. I was also advising, and recently it has been announced 2 days ago, where I used to be on the board of that company, but the European infrastructure giant Ferrovial has committed to invest in a company 25% stake or 24.9% stake they are taking, and they are willing to commit their balance sheet for all the future projects being funded. They will provide all the equity contributions and go up to 49%. Means it's the assets which has not been constructed. They are coming at the holding company, and they are committing for all the future projects which will be done in a separate SPV. Their contributions will be there up to 49%. That suggests that they are not feeling comfortable with the policy of the government, with the ability of the government to take tough calls and also facilitate and take all the policy measures which actually provide a better platform for them to invest.
All right, let's take some questions from our audience there. Please go ahead, introduce yourself and speak your mind.
So, my question to you is how the risk-taking facilities is different, and how can we ensure that there will be no liability issues in DFI?
See, as I said earlier, that banks by nature, they raise resources either through time demand deposit, which is in the form of fixed deposits, and also the current account or the saving account where they have the money from the account holders. So that forms the liability they have. On lend, if they want to, and the average maturity of that put together is generally, I'm saying that around 1 year. In some bank, you'll say 9 months, 1 year, 1 month, but it is more or less 1 year. But the assets which you are acquiring means the loan which you are giving to a infrastructure project, which has a door-to-door maturity of 25 years, or the first 3 years construction, then of course the concession period. You will start, your amortization will start after 3 years once the construction period is over, and there is a cash flow which is being generated by the projects. By then, but the bank has liability of 1 year, and then they are taking risk of 20 years, 25 years, is something which they expose to credit risk, market risk, various other kind of risk bank is taking. So what the development financial institution does, they raise long-term liability. So their liability is like 20 years, 25 years, 40 years, 50 years. In US, even 99 years liability they raise. And then of course they lend to a project which has a maturity of 25 years to 40 years to 50 years, means there is no mismatch of asset liability because it is being monitored by the institution on a daily basis. That there is no mismatch. If the duration of your asset is 5 years, then duration of your liability is also 5 years. So that way they are able to address the asset liability mismatch.
All right, I have time for last two questions. Let's take them together.
If I can just add to that.
Yes, sir.
You know, there is a live example that I wanted to share and one concept I wanted to share. There is in finance something called the internal rate of return, which is how quickly you're going to get your money back and at what rate. There is another concept called economic rate of return, which is that your profits may not be very high, but the economic benefit to the country at large is huge.
Hello, sir. My name is Jyotika. So, with the National Bank for Infrastructure and Development, we're all talking about attracting foreign players and big players. But we all know that this is an era of MSME, micro, small and medium enterprises. So, is there any special provision available in this act that will cater to the needs of MSMEs?
My question is that you just mentioned that it is a risk-free bond. So, we know that with many advantages, there are some disadvantages also. So, is our government is ready to face that?
It's a risk-free bond means government is giving guarantee to those bonds. And what is the disadvantage to the bank, to the government, that they are committing something, it's a budgetary allocation they will have to make. So to that extent they are committing here and giving guarantees, to that extent they will not be able to allocate funds to some other places. So because it's a commitment by the government and it's a budgetary allocation, because every guarantee which government gives, it is approved in the budget.
Time for closing comments from both my guests. Mr. Islam, coming to you first.
No, I think but since youth and youngsters are here, I must tell you that we are fortunate that we have been born and we are alive in today's situation, because a lot of opportunities will come in our way, primarily because there is a growth story for India. Everything is happening in India, which people were initially earlier talking about it. And the world is looking at us, and you people who are actually educated and become part of the labor force which we have in the country, you will be white-collared, of course, labor force. And then the kind of opportunities which is being created because of the policy reforms being undertaken, and structural reforms which is taken, and all the important reforms which is taken, and the bold decision which is being taken by the government, you will be the direct beneficiary. MSME will be there, institution will be there, but you will also be the biggest beneficiary.
All right, Mr. Pathak.
More will happen in India and in Indian economic development, particularly infrastructure, in the next 10 years, from 2021 to 2031, than has happened in the last 30, 40 years. So this is a great time to contribute to this success story. And all of you in the audience and all of you watching this show are going to be part of the solution. Far too long have we cribbed about problems. Now with speed and scale, it is time to deliver solutions. Thank you.
All right, so for a developing country like India, it is desirable that the new DFI remains viable and sustainable to be able to cater to the long-term development financing requirements. That's all we had for you in this edition. Thank you so much for joining us, Mr. Islam and Mr. Pathak. Next week, we'll return with incisive analysis of another important bill. Till then, take care and stay tuned to Sansad TV. Namaskar.